Have faith in your mind, have faith in your grind. Invest in yourself, transform in your time. Have faith in your mind, have faith in your grind. Invest in yourself, transform in your time. When you trade and get paid, trade and get paid, trade and get paid, trade and get paid, trade and get paid. Oh yeah, trade and get paid, trade and get paid.
All right, so let's talk about what a PIP is. What is a PIP? That just means percentage in points. And so really what we're saying is that when you look at currency, there's more numbers after like what we use, right? So in the example I gave you before, we were looking at euro and we were looking at USD. So if you're looking at euro USD and the current price is 1.1023, there's another number there that fluctuates really fast called a pipette. We really don't use that very much. And so for the purposes of this video, I'm really not going to go into that because I would never really teach you to want to trade that, okay? So for the purposes of this, what we're saying is that we generally look at money as like $1.01, right? We would generally say like $1.01. But what we're really saying is a pip is the fourth number after the decimal. So in this case, we'd be talking about the 3. So euro USD means that you are trading one, this is the base currency, okay? So let's write that, base currency. And this is the quote currency. And what that means is that the euro, or the first currency, is the base. This is what we're basing our price off of. And the second currency, or the quote currency, is what are we leveraging the currency against. So in other words, 1 euro is worth 1.0123 US dollars. That's base and quote currency. Now, we're also going to have to talk, before I get into what is a PIP, is what is your bid and your ask price? Because when you look at your broker and when you look at your like MT4 or Thinkorswim or whatever it is you use for your trading, you're going to see two prices. You're going to be looking at what's called your bid price and your ask price, okay? And when you look at that, you're going to see two numbers. One of them is going to be like what I just showed you. The next one is going to be slightly different. It might be, okay? And so when you see a difference, what you're seeing is this is how much a broker is willing to pay for that currency. And this is how much a broker is willing to sell that currency for. So if you are doing a buy, you're going to be looking at that number. If you're performing a sell, you're going to be looking at that number. And that's important to look at because the difference is what? It's in the pips. We trade pips. We don't trade pennies. We don't trade dimes and nickels. We trade pips. And so let me get to what that means. Let's use that same example, right? Euro, and we're looking at USD, let's just say. And so the bid price and the ask price, okay? And what that is this is what the broker is willing to pay for a currency, and this is what the broker is willing to sell a currency for. So let's say that the broker has a bid price, like we just said a few minutes ago, but the ask price is this. You see the difference would be here, right? And so that fourth number being the pip is the difference. We call that a spread. And that's something that is very, very important for Forex traders, especially those who are scalping and doing short-term trades. And we'll talk about spreads in another video. I want you to watch the video up above because I actually show you how to trade spreads in a strategy, and really a very profitable strategy. So what we're saying here is that when you are buying a currency, if you're going to execute a buy in the market, this is the price you're going to buy for. And if you're executing a sell in the market, this is the price you're going to sell for. The difference is the spread. So if we're looking at Euro USD at 1.0123 and then ask being 1.0124, the difference is that PIP, right? So 1, 2, 3, 4, this is the PIP. So here's why that's important, right? So let's look at this for a second. So we're looking at this number, and so we're looking at, and we say 1.01, okay? This last number, imagine it this way, and this is kind of a good way to understand it, like when we do math in school, like you have the hundredths, the tenths, and the ones, right? The place value. So you would be looking at this and it's 4, 2, and well, we already got the 1. So let me just, so if you were looking at this number, this would be the hundredths place, this would be the tens, and this would be the ones, okay? So what we're really saying here is for every penny, if this changes to $1.02, 1.02, then this would have to change 10 different times. This would have to roll over 10 times. 4, 5, 6, 7, 8, 9, 0. 1, 2, 3, 4, 5, 6, 7, 8, 9, 0. 1, 2, 3, 4, all 10 different times. And every one time, like almost like a mile, what do you call that, odometer on a car? Every time you see that number roll over, then the next one rolls over. So if this gets to 10, this turns into a 3, this turns into a 0. And then once that rolls over 10 times, this rolls over and this rolls over. And so essentially you have, for every penny, for every 100 pips, there's a penny in price difference, okay? Now, that sounds amazing because when we look at the exchange markets, we see the prices fluctuate by pennies every single day. 100 pips, that sounds like a lot. Well, we're really only talking about the market having to move pennies, which is why Forex is so powerful. Because when we trade Forex, we don't need price to go from $1 to $2 on a currency. We don't need price to change by dollars and dollars. All we need is for price to change by a penny or even less. Small fluctuations can be made into large profits when you trade Forex the right way. So a PIP is something that is going to be very important as you begin to trade Forex and as you continue to trade Forex. A PIP is going to be something that you're going to hear all the time. And what you want to remember is that it's the fourth number after the decimal. Now remember this too, a little small tidbit. When you're looking at JPY pairs, it's no longer the fourth number after the decimal, but it's the second because JPY pairs are a little different. I don't really trade JPY, which is why I'm not really talking about it in this video, but I do have other videos that talk about that and I'll mark them above.